Bitcoin just broke something for the first time in this entire bull cycle, and every single time it's happened before, it's marked the start of the next bear market. So in today's video, we're going to break down exactly what just failed, why the cycle is fundamentally different from anything we've seen before, and what the on-chain and statistical data is really telling us about the downside risk from here. So let's get into it. Today's video is going to be a bit different. I'm not here to give you any hopium or to cherry pick any bullish outcomes. We need to be brutally honest about where Bitcoin currently is, because something has just happened that hasn't happened once in this entire bull cycle so far. We've closed multiple times below all three of my key technical pricing levels: the short-term holder realized price, the 200-day moving average, and the 365-day moving average. Now, the first two are currently sat at $110,000, and the 365-day is at $102,000. And every time this has happened in previous cycles, it's marked the beginning of a bear market. And that doesn't automatically mean we are in a bear right now, but it absolutely means that we need to take this possibility seriously. So let's start with the obvious question. Why are we drawing down so hard? Well, that's not the main topic of this video, and I'll cover the drivers behind this drawdown in a separate future video. But what I can tell you now is that long-term holders have been realizing an extraordinary amount of profit. And what's even more unusual is that they've been doing it during the downtrend, and that behavior is extremely rare. Historically, long-term holders distribute into strength. They sell when price is rallying, and they take advantage of liquidity. But this time, they're selling into weakness and have actively added to the downward pressure, and that alone tells us that something about sentiment and conviction this time is different. Now, when we look at the local price action here, it's undeniably bearish. Every structural level is getting sliced through each time, and if you look here at the past 2 years, the $93,000 region, which used to act as a structural shelf, is now starting to flip into resistance. And if you're macro bearish, this is the level where a lot of people will likely jump for the exit. And if we lose 90,000, there's a very real air pocket on the chart. There's very little respected price action between 80 to 90,000. So I could see a fast, almost vacuum-like move down to the next major shelf around the $70,000 to $75,000 region. And there's been strong volume and consolidation around that band, so that's the logical next high probability zone to catch the price. And yes, we do have a big historical support band below that at around $50,000, but I'll show you later why I don't think we get anywhere near that this cycle. Now, if we quickly look at the local volume profile, there's been a healthy amount of volume traded around the mid-90s, which tells us that buyers and sellers have genuinely agreed on value around there in recent months. And that is usually where you'd expect price to stabilise if this is just a corrective phase. And ideally, that area becomes a base or some sideways accumulation range. But if that fails, and we lose $90,000 with real momentum behind it, things will likely change fast. Like I said, there's that structural void between $80,000 to $90,000 where the market's barely traded, meaning there's no clear support until price reaches the next high conviction zone. And with the local volume profile, that next equilibrium point is at the top of the 2024 consolidation range, because that's where previous buyers have defended the price, and it also aligns with the strongest cluster of traded volume in this entire macro structure. And that's the kind of level where price normally finds participants again, simply because history has proven that buyers are willing to step in there. Now, let's back that technical picture up with a bit of on-chain data. The short-term holder cost bands are one of the most reliable trading range frameworks that we have for the entire Bitcoin market, and I use them all the time. They're all derived from the short-term holder realized price, which is essentially the average cost basis of coins that have moved within the past 5 to 6 months. And because short-term holders are the most reactive participants in the market, they exert a massive influence on local price action. Now, here's the most important bit. When Bitcoin has genuinely entered a prolonged downtrend, or even a bear market, price has spent most of its time oscillating between the bottom two cost bands, which are the green and blue zones. In practice, it means that price tends to get rejected any time it tries to reclaim the short-term holder realized price from below, because everyone who bought at those levels in recent months is trying to exit at least at break even, and that creates a semi-permanent resistance for the bear. And right now, the lower cost band spans between $72,000 and $88,000. And that gives us a very clear framework. If we're under the short-term holder realised price band, we're in a danger zone structurally, and the default assumption is that volatility stays to the downside. And with that assumption, I'm going to trade that dynamic range spanning the green and blue cost bands all the way down to the eventual bottom. And while we're talking about potential bottoms, let's talk about drawdowns and zoom out a bit. Now, historically, Bitcoin has always found at least a 70% drawdown from its cycle peak, but that kind of retracement has always required a blow off top first, and this cycle never saw that, or even got close to it. There was no parabolic vertical price action or any sort of FOMO-driven mania, and you won't believe it given the extreme negative sentiment online, but we've actually only had about a 22% drawdown from the all-time high so far, and the bears hate to hear it, but if you've been around Bitcoin for at least one cycle before, you know that's actually a very normal bull market correction. But the only unusual thing about this time is the extreme sentiment. People are acting like the sky is falling, even though this drawdown is actually pretty mild by historical standards. But let's stop thinking in these raw speculative percentages and bring in something far more objective. The short-term holder drawdown chart, in my opinion, is one of the best regime indicators we have. Far more useful than simply guessing maybe we'll get a 70% drawdown, or maybe it's more likely to be 50%. Essentially, that's all just pure speculation. And it does make sense. A slow bleed off top like the one we might have just seen now will logically have a shallower drawdown profile, but logic doesn't always play out in this market. So while I would like to say with complete confidence that a 50% drawdown is the most likely scenario, we can't be sure of that. So what this chart here does is track how deeply short-term holders are underwater relative to their cost basis. And when the chart dips into these deep red zones, that's where you've historically seen maximum pain and maximum capitulation. And every single Bitcoin bottom has taken place in that deep red zone. But to put it simply, the chart just simply shows us how far the most recent participants are below their average acquisition price. And it's one of the best ways to get a quick snapshot of the total pain in the system. And when everyone starts panic selling at heavy losses, you see it right here. And historically, the worst drawdowns on this metric have always clustered around the 60% drawdown level. That's been incredibly consistent across multiple cycles. So instead of trying to predict perfect price range targets directly, I treat this chart as a regime detector. When it's in deep red, it's in bottom territory. And when it recovers above zero and stays there, that's historically when the new bullish phases resume. Now, for those of you who have been around for a while now, you'll probably notice that these charts look slightly different to my usual ones. And that's because they're part of a brand new charting suite that I've been building for my upcoming website, which is scheduled to launch in the next month or so. So if you want to be first in line to get notified when it goes live, you can sign up to my newsletter using the link in the description below. Now let's move on to my Z-score probability waves. And if you've been following my channel for a while, you know this is my favourite macro statistical tool. And the reason I rely on it so heavily is because it gives us the ability to quantify price extremes in probabilistic terms, and not just gut feel. And for the first time in this entire cycle, we're now dipping into negative Z-score territory on the macro overlay. And every time that's happened in the past, we've entered a bear market, except one time around the pandemic crash, which was the ultimate black swan anomaly. But what this indicator does is measure how far price deviates from its statistical mean. And what we can see very clearly here is that every bear market has bottomed somewhere between the -1 and the -2 standard deviation bands, which are the green and yellow lines, except for the last cycle, which briefly dipped below the -2 band during the FTX collapse. So that gives us a realistic expectation grounded in probabilities of where price could bottom if this is a breakdown into a true bear market. And right now, those most extreme levels sit between $60,000 and $78,000. So let me try and spell this scenario out as clearly as possible. If $126,000 was the top, and I'm not definitely saying it was, but if that was the cycle peak and we slowly bled out from here, then the most extreme deviation target to the downside is $60,000. And that would equal about a 50% drop from the all-time high. And honestly, that's extremely reasonable considering that we'd never had a blow off top. In fact, it'd be the mildest bear market in Bitcoin's entire history. And here's the thing I find fascinating. The statistical measures, the cost band model, and the structural price action are all in agreement. everything's pointing to the same rough downside range, and that level of confluence doesn't happen often. So when I say I think the worst case scenario is a drawdown to $60,000, I'm not just making it up, the math actually agrees. So let me tell you exactly where I'm at right now. We're sitting at a majorly critical point in the market structure. If we lose $90,000 with real momentum, it's not going to look pretty. There's barely any structural support in the low 80,000s, and the volume profile is very thin. That means a breakdown will probably accelerate as sentiment gets truly shattered. And if that happens, my first primary target is the top of the 2024 consolidation phase, which lines up beautifully with the lower short-term holder cost band at around $72,000. So if we go below $90,000 decisively, I'm flipping bearish in the short term and preparing for a move towards those levels. And if that fails, then the Z-score probability weight framework shows that a final extreme downside scenario is about the $60,000 region. But realistically, it's going to take a lot of work and brute force against the bulls and the structural institutional bid to get all the way down to those statistically extreme levels, even in a true bear. So if that happens, if Bitcoin skips the blow off top, has a bear market that draws down approximately 50% and then resumes its macro uptrend, then this would make it a genuinely unique cycle, and we'd never seen anything like it. And the one metric I'll be watching more than anything else, once we do enter that downside zone, is the short-term holder drawdown chart, because that's the one that's consistently flagged major bottoms in real time with no lag, even as Bitcoin's market has matured. Now, before I wrap up, let me be very clear about something. My medium to long-term outlook is still pretty optimistic. I'm not a perma-bear and I'm not rooting for lower prices, although I would be heavily stacking sats at those generational discount levels. But the macro backdrop right now is unbelievably favourable for Bitcoin. Monetary policy, liquidity, supply dynamics, institutional adoption, they're all huge tailwinds for the longer term that could potentially serve as a catalyst into 2026. And while this video is solely focused on the downside scenarios and the probabilistic structure of a bear market, my premium subscribers know exactly what I was doing over the weekend to position myself for both possibilities. I'm not going to be putting a bullish spin on this video at all, I'm just going to be calling it how it is. But in the middle of all this noise, there have been some extremely powerful long-term signals that have only triggered a handful of times this cycle, and they flashed this week. So if you want a full breakdown of my thoughts on both scenarios, I covered it in detail in my previous newsletter. So to wrap things up, we're at a genuinely pivotal moment in the cycle. Losing all three of those key technical thresholds, the short-term holder realised price, the 200-day and the 365-day, isn't something to brush off. Historically, that kind of structural breakdown has marked the very beginning of prior bear markets, so we have to acknowledge that risk instead of pretending that it's just business as usual. But that said, if this is the start of the bear market, the data strongly suggests that it won't look like previous ones. And because we never saw a true blow-off top, the downside is likely to be far more constrained. The cost basis frameworks and the historical drawdown profiles all gravitate towards the same region, somewhere between $60,000 to $70,000, and that's no doubt still painful, but it's nothing like the previous 80% collapses people imagine when they think of a Bitcoin bear. If this is truly it, then this cycle really doesn't fit the classical pattern in any shape or form. And finally, that's why the real key now is to focus on the metrics that are not just dependent on how the cycle actually plays out. The short-term holder drawdown chart is still, in my view, the most reliable real-time capitulation detector we have. When we see deep red on that chart, that's historically been the moment where generational entries appear right in front of us. And pair that with the probability waves, and you have a framework that not only warns you when the worst is happening, but also gives you the statistical confidence in when the trend is turning back up. But the real bottom line of this is, we might be at the edge of a bear market, or we might be in a standard 22% bull market correction. And the truth is, you'll only know which one it is after the fact. But what you can control is how you position yourself for either outcome. If you're convinced this is a bear market, are you prepared to sell your entire position now to try and buy back in $20,000 lower? And what happens if you're wrong? What if price re-rallies back above $100,000 and beyond? How are you going to act then? These are the questions you need to be asking yourself if you're considering high-risk strategies like this. And it's easy to dismiss these thoughts and pretend that they'll just never happen to you, But being married to a single narrative is a really dangerous game. If your entire strategy hinges on one outcome, you're not managing risk, you're now just gambling. And personally, even when I've been convinced that we're at a cycle top, or the start of a bear market in the past, I never fully exited my position. And that's because I've been around enough cycles to know that there's always a chance that I'm wrong. So the faster that we all accept that we're all human, no matter our experience levels, the better our long-term investing decisions become. Because the market doesn't reward certainty, it rewards those who stay adaptable. So, as I always say, use the data and always prepare for both outcomes. And when the floor finally comes in, whether that's this year, next year, or beyond, be ready to seize it.